the new tax law. So what are their majorly their coverage and scope and the objectives, and what is the underlying intention? So a lot of people have I know a lot of things are just everywhere. A lot of is this government trying to send us back to our villages? What is their intention? What I must assure you that this is also one of the best things that would have happened to us in Nigeria. So the new tax law is aimed at ensuring there is development, both for even us as individual and also for the country at large. So looking at the characteristics of the Nigerian Tax Act itself, the first one, if we look at the coverage and the scope, is comprehensively looking at bringing all the taxes, making it comprehensive enough for us to, so thank you, under the slide too. So comprehensive tax code for Nigeria. Pastor, are you sharing already? Thank you. Yes, fine, yes, thank you. So we notice that the Nigerian Tax Act is also the aim or objective of it is to have a unified fiscal legislative governing administration. I will not bore us with too many terminologies, but what I'm just doing here is to make sure that we have an overview of what we are talking about. Then we'll go into company income tax applications, we'll go into personal income tax applications, because most of us here, I know, will be having different interests to look at, and that is more reason why I'm giving this overview. Then the Nigerian Revenue Service, like I said, what is their aim? Is to strengthen and centralize the tax system. Then the joint revenue, like I also said, is to harmonize and coordination of tax administration. That's the intention of the joint revenue tax. So if we also notice, so from there we'll go to some of the exemptions that, so first and foremost, before I talk about the exemptions, can we talk about who a small company is and who a large company is and who a mid company is? So any company that whose turnover is in a year 100 million and below, and whose fixed asset does not exceed 250 million in a year, is considered as a small company. So ask yourself, what kind of company are you running now? If my revenue as a company is 200 million in a year, so formally in the former act, it used to be 25 million. For some of us that are very conversant with this, it used to be 25 million. Do you understand? For us revenue, but now it has been raised to 100 million. Even though the Nigerian Tax Act is still saying it's 50 million, the Nigerian Administration Act, which is the one that administers Act itself, is saying 100 million. And from conversations with the custodian of the revenue, which is the Nigerian Revenue Service, which is now Federal Inland Revenue Service, they've also emphasized that a small company is a company whose revenue is 100 million and below, and whose also fixed asset does not exceed 250 million naira per annum. So what that means also is that, to give you an idea, for me as a tax person or as a tax consultant or as a consultant in the company or tax professional in the company, what do? I just make sure that I look at the threshold. Once my fixed asset is hitting 250 or above, what do? I'll think of something else to do, so that I do not move away from small company into a large company. So any other company that is above this threshold is considered as a large company. So once so what do? The first thing I'll just be, as a tax planner, I'll say, no, let me watch my fixed asset, let me watch my revenue. You keep watching it. You understand? If your fixed asset, for example, is about exceeding 50 million, you can think of what? Maybe lease, rather than buy the asset as your fixed asset. You can just lease. So you can lease that asset, that particular asset, you want to also add to your existing asset, such that you are looking, so that is one of the way you can do your tax planning. so that your fixed asset does not exceed, because it will not be counted as part of your fixed asset, but you'll be taken as what? As asset held under lease arrangement. Okay, so moving on, please still stay on this slide. I still need to explain some things on this slide. So then, like I said, small company, what are your exemptions as a small company from tax? So once you have met up with that threshold of, I said, 100 million and fixed asset 250, you are not going to pay any tax. So there will be exemption from CIT, which is company income tax, CGT, company gains tax, development levy of 4% now, which used to be Cascaded Police Trust Fund, Laseni. That's what it used to be before now. But so you are exempted from all of this tax. Then that is all on this. So that is all on this. Next slide, please. Thank you. So I've taken a summary of this. Next slide, please. Okay, good. So can you hear me, please? Can you hear me very well?
Yes.
Okay.
Yes, please.
Okay, thank you. Okay, thank you.
Yes,
So,
I can hear you.
Okay, thank you. So going to the CGT, which is the increased capital gains tax. So somebody will ask me, what am I talking about capital gains? Most of us here, do we have an idea? So I know we have differing interest in the house. So capital gains tax has to do with gains on disposal of your investments or assets. So the gains you make on it. So now capital gains used to be 10%, but it has now been moved to 30%. And what's the reason? It's to align the rate of capital gains and that of the company income tax, which is 30% for companies that are not small. For companies that are not small. So any mid and large company will pay such taxes. Capital gains tax or CGT tax at 30%. Then the tax rate, so it aligns CGT with company income tax, reduces also arbitrage that happens, during trading income, and individual treatment. So individual tax also at applicable tax band. The next slide, please. So remember that PIT, personal income tax, is also on a progressive tax system. So CGT on indirect shares, for example, now let's go quickly to this on indirect shares. So the new tax law states that for your capital gains, any sale of shares of 150 million of that is less than or equal to 150 million in 12 months in a year is tax exempt, provided also that your gains on it does not exceed 10 million. But where you're making more, maybe where your shares for in a particular year is above 150 million, then you pay tax on the difference. But also, there's also a respite. Once you have made such a sale and you reinvested it within the same 1 year, then you are not still going to pay tax. So because that sale you made, you invested it within 1 year, you are still covered from paying CGT tax. Thank you. Next slide, please. I need to be fast because we have a lot to talk about. And the slides are plenty. So now the introduction of development levy, like I said, the development levy is also part of the levy that for companies, after your company income tax is charged, then you see development levy also, just as you have education tax, and that development levy will be charged at 4%. So before now, it used to be information technology levy, it used to be tertiary education, which is education tax levy, and then Naseni and police trust fund. All these four were all at different rates according to Finance Act. But all of them cumulatively came to about 4.2%. But now the new tax law said no, let's call all of them development levy at 4% of the accessible profit of the company. So a small company does not need to pay this, but a large company will pay development levy. Thank you. Next slide, please. Let's quickly look at a summary of what I've just talked about, and some business incentives. So small company, like I said, 0% tax. Other companies will be 30%. MNE and other companies, 15%. If lower, you top it up. So MNEs are national entities and other companies. So then startup, no tax, 0 tax. Agricultural companies, 5 years tax holiday as an agricultural business company. Then companies in priority sector also have 5% annual tax credit. So who are the companies? 5% annual tax credit over 5 years on their EDTC, that's economic development tax credit. They will have that for 5 years in priority sector. And what are the companies in priority sector? Companies that are like into mining, yes. Then fishery, all of these deep fishery, all of those were also part of oil and gas, deep refineries. Yeah. Okay. So small companies less than 100 million turnover, they are also exempted from tax. I've talked about that. Small companies, manufacturers, and agricultural business are exempt from withholding tax deduction on income. So small companies are exempt also from deduction of payment to supplier. Small companies are exempt from the 4% development levy, which is next slide, please. I hope we are following.
Yes.
Can you hear me, please? Can you still hear me? Internet is telling me
it's
unstable. Okay, thank you very much. Next
slide.
slide.
I hear you.
Okay. Okay, so the coming to minimum effective tax rate. So this is applicable to MNEs mostly. So for example, oil and gas companies and the rest. So what this rule is saying basically is that MNEs with 20 billion turnover and above, the minimum effective tax rate must not be less than 15% of their profit on taxation. So where it is less than, it must be top to make sure that it comes to 15%. So this is a bit technical, but so what that means is saying, what it's saying is that it's not saying that your 15% CIT should be applied directly. No, you still charge your 30% CIT, company income tax, on such profit. But when you have charged it, you now have to do what we call a test for ETR. After the test for ETR, you will now ascertain whether what you have charged is commensurate to effective tax rate. If it is not, then you have to pay more. But if it is, you have to leave it at what it is. So let's go to the next slide so that we can look at it. Just demonstrate quickly what we are talking about in the next slide. Okay, I think I'll also be going with my own slide so that I'll be checking to be sure that we are on the same page. Okay, so look at this scenario. Can you see the scenario? Fine. Look at this scenario. A multinational enterprise, MNE, operates in Nigeria with the following figures. Net profit before tax is 10 billion and depreciation expense is 1 billion. Personnel cost is 2 billion. CIT rate is 30%. The NTA 2025 says that for ETR calculation. So for ETR calculation, what do? You have to determine your adjusted profit. So from here, you determine your adjusted profit. What will be your adjusted profit? Your adjusted profit is basically 5% of your depreciation plus your personnel cost. So in the next slide, we can determine that. So what that is saying is that 5% of depreciation, which is 1 billion plus 2 billion, that gives us 5% of 3 billion. What does that give to us? Whatever it gives to us is your adjusted profit. Then you calculate a CIT rate of 30% on the same. Any questions? Is somebody trying to ask a question? Can I go ahead, please?
You can continue, sir.
Can I go ahead, please? Because someone just interrupted now.
Yes,
Okay.
You can
Okay,
continue,
thank
sir.
you.
So
Okay,
sorry,
so step
bro Sam,
one,
can I
like I
quickly ask
said,
a question?
okay, step one,
Did you
please
hear
go
me, bro?
ahead.
So I'm thinking
I
the
can hear you. Mm,
deductions, is it just the personnel costs
yeah.
or the operating expenses?
So, the law is specific. It said personnel cost.
So what about
That
so you will not remove operating expenses from your
you
from
know, yeah, you will not, you will not, you will not, you will not. You remember, if you remember the way we usually do our write back for most of the non-cash items. Do you understand? So you remember the way we usually adjust back our profit when we want to calculate the company income tax normally and capital allowance application. Remember? So
yes.
because inflation is a non-cash item, that is why it's been adjusted to get your adjusted profit. Then the law now provided that personnel costs too should be given as an incentive to enjoy this benefit. So it's basically 5% of your depreciation plus personnel cost. Can I go
Okay.
ahead?
All right, please go ahead.
Thank you very much. Okay, so that gives you your adjusted profit. So when you have your adjusted profit, then you calculate your CIT normally, which is that same 30% of what 10 million. So whatever that gives you, you compare it with your adjusted profit. So the next slide, please. At least you can understand if you understand what I'm doing up to this place. Here at this point now, I've said 10 million minus 150, which means saying I've calculated the adjusted profit to be what? 5% of 3 million, which is 150, 3 billion, which is 150 million. And I've calculated my CIT of 30% on 10 million. Next slide, please. No. Let's go back to the other slide before this next slide. The solution to ETR continued. The other slide. So you will see how we calculate corporate company income tax of 30% of that 10 million, which is our profit before tax, net profit before tax, which is 3 million. So calculating effective tax rate, all you need to do is CIT divided by your adjusted profit, which gives you 30.46. So now from this rule, you will now ask yourself, my effective tax rate is 30.46. Can we see that? And the rule says that if it is above 15%, then the company does not need to pay any top up. But where it is less than, that's where you need to do a top up. So from what we have calculated, that means that, which is 30.46, that means that the company does not need to do any top up. It goes ahead and pays its tax. So the next slide, please. Next slide. So economic development levy, I think we have talked about this one, but let's talk about it more in full. So this one replaces the pioneer status incentive that we used to have. And I said it's 5% tax credit for 5 years on qualifying capital expenditure, CapEx. Pastor, sorry, is a slide before this that you need to show to me. We have not gotten to this personal income tax. We are on slide 13. We should be on slide 13. I'm so sorry I could not share myself. I will have slide that's it. This is slide 13. Okay. So, like I said, the introduction of this EDI or EDTC, the act replaces the pioneer tax holiday incentive with an economic, which is an economic development incentive. The incentive introduced a tax credit of 5% per annum for 5 years qualifying capital, the production date. So if a company has used tax credit or qualifying capital expenditure, it can, if a company has unused tax credit or qualifying capital expenditure, it can carry them forward for another 5 years, just as you carry forward our unutilized losses. Also in this, they can carry forward for another 5 years. Any credit still unused after this timeline will expire. So, which is a period of after another 5 years, then you cannot utilize it anymore. Okay, next slide. So let's quickly go to personal income tax overview. Okay, so like I said, the Comprehensive Tax Act, NTA, integrated with Nigerian Revenue Service Act for Unified Administration. So the relief system, we have some relief system, which is number one is the tax relief of 800,000 naira for income people. So a tax exempt of 800,000 naira revenue in a year. Then a relief of 20% of your rent relief. So this one replaced the consolidated relief allowance that we used to have according to Finance Act. You know, that one that talks about, I think 20% of your gross income plus 200,000, whichever one is higher. So this one replaces that law, rent relief. So 20% of rent paid, but it has a cap, cannot exceed 500,000. So an example of this, that a lot of people are making mistake here. To ask the question is that, does it mean that are they talking about rent of 500,000 naira? They're not saying the rent should be 500,000, please. What they are saying is that 20% of your rent, if your rent is 1.2 million, what is 20% of 1.2 million? That's exactly 10% is 120, 20% will be 240, right? Which means that the relief will grant you 240,000. But where your rent is 3 million, 20% of 3 million will be what? 600,000. The law will only allow you to take 500,000 out of your 600,000 as a relief. That's what they are saying here. I hope this is clear. Then the residency text, also clear. So international aligned criteria for determining tax residency and global income obligation. Then benefit in kind also, which is robust evaluation method with specific guidance and minimum threshold. So for benefit in kind, the tax base expanded to include global income for residents, digital economy earnings, and other forms of modern compensation. So there are a lot of things too associated to this. We'll see them as we go. So enforcement, fully digitalized PA system with automated compliance check, also real-time reporting and integrated data analytics. That also is available. I can share that if time permits. We just do 1 or 2 tests so that we can also determine what our personal income tax looks like. Nobody will tell us or try to bamboozle us on that. So the next slide, please. Why that is happening, I will send that to Pastor Ayon now so that I can put it on the chat so that we can quickly look at that demonstration also. Okay, so this slide is telling us about the new tax rate. So that is the structure of the new tax rate. So the first 800,000 is at 0%. Then the next 2.2 million is at 15%. Then the next 9 million is at 18%. The next 13 million is at 21%. Like that. So you will see what does this aim? This tax is aimed at giving relief or respite for low income earners. That is just what is geared to us. It's just to give some respite for low income earners. So let's give a small test. So let's go to the next slide. We just do 1 or 2 tests. So let me not bore us with too many technicalities. Sorry, I'm trying to look for this tax table thing. Just give me a minute. I'll find it now. Find out now. Because I know a lot of people are interested in how to calculate their personal income tax. Okay. Are you there, sir? Pastor Ayo, please, I sent something to you now. You can share that link on the WhatsApp. Okay, so let's go ahead. So the next slide, the new residency rules for individuals. Yeah, so we already know. So it did not abrogate the fact that 183 days rule. It didn't abrogate that fact, but it just did so much more expansive understanding on some of these things. So, for example, if you are not in the country, so that you know that there's what we call physical presence and physical president and physical residence, so and or something like that. So you don't have to be in Nigeria for too long, even if you're outside country for the next 2 months or 3 months. We have shared it on the WhatsApp, on the chat, right? I can't see. I can't see the slide anymore. Pastor Ayo. Hello. Okay, let me continue.
You said we should share the link. I'm trying to open it on the browser.
Okay, thank you very much, sir. So, while we're doing that, okay, so for example, permanent abode, having a permanent home available in Nigeria, even if physical presence is less than 183. So normally, you know that the 183-day rule says that individual present in Nigeria for 183 days or more in any 12-month period are tax residents. Yeah. So then he's saying that even if having a permanent home available in Nigeria, even though and if physical presence is less than 183 days, so you also need to pay tax. Or center of vital interest, for example, establish economic and personal ties in Nigeria, indicating it as a primary center of life interest. If, for example, you are in UK for some time and your business is still running in Nigeria, you still have to pay tax. Still have to pay tax in Nigeria. Or global income taxation, tax residents are liable for tax of their worldwide income. Or anti-breaker clauses also clear criteria provided for resolving dual residency case based on international tax treaty. For example, if you have a dual residency case where you are paying tax already in UK, so and you still have some, you are coming back home, you have some business running here or whatsoever you're doing here, but you are paying tax in UK as you are in UK. If you come back to Nigeria, you still have to pay tax, but what you don't have to pay all of them because there is treaty. So what that means is that they will assess your tax in Nigeria. Whatever you have paid in UK will be taken as a net off so that you can pay any balance therein. Please don't ask me about any tax credit, whether you get your tax credit if you have overpaid. I hope that's not funny, right? But you can always take that as a relief anyway, if you know how to do your tax planning very, very well. Okay, so let's take this example. Let's go to slide 17. Practical example, an employee with, are we there? Oh, Father. Don't know whether we are still sharing this. Okay, Pastor Ayo, can you share? Can you? So everybody will practice. Okay, maybe we should practice it. Okay, let's practice. I don't know how we're going to do. Okay, yeah, that's the question. So everybody will just punch their calculator. They will enter the information on that link I sent to determine what their tax looks like. Or we can even test with this one that we have done here. I can't, it's not showing it's not coming on very well. Okay, so An employee with 3 million annual gross and gross emolument. Okay, let me just practicalize it. Let me practicalize it. Oh, sorry, I can't share my screen. This is painful. Yeah, it's painful. Okay, so what do
can
we?
you try to share now? Let me stop sharing. Let's see if it's going to work now.
Okay. Sorted, man.
Bro Sam, any luck? Hello, bro Sam, any luck? Hello, bro Sam, are you still there? Hello?
Me to quit and reopen. Sorry, that's me to quit. So that's why. So it took me out. Host disabled participant screen sharing. Sorry, the thing took me out. I had to come back again to it.
I've made you a co-host again. Can you try it
Okay,
now?
let me try it now. Sorry. Can you see my screen?
Hallelujah. No, now WhatsApp you dey show us. So.
Yes, there. Don't worry. I'm sharing my entire screen, so you get that now. That's fine. So can you see my screen now?
Yes, good. Yeah, it's better now.
Okay, thank you very much. Okay, good. So I think we're somewhere here, right? So if you look at this practical example that we did here, employee has 3 million annual gross income, paying 1.2 million as rent. So the 3 million is total income. The tax exempt is 800. The 1.2 million will be 20% of 1.2 million. So you will notice that that is 240. So that means that it's only 240 we will apply. We cannot take 500,000 in. Even so, the maximum is 500,000. So 240 will apply. His pension is 8% of 3 million. We took his gross income as pensionable, totally pensionable amount. You know, for some other tax planning thing too is that you can have allowances broken down into basic housing and transport and other allowances and some other things. So if you do that, that means that you only have apply 8% of your pension on your BHT, which is basic housing and transport. So that will help you to have some other advantage, in having more money in your pocket. Your pension, though, will be a bit reduced, but then it could have more money. So those are some of the tax planning things you can always look out for. Okay, so if you apply all of this, the taxable income will be 1.645 million. So let's that is that. So let's practicalize it with that link. Let me try to pick that link. We can also do an Excel. I can also share an Excel where you can also have an Excel where you can also do your own thing yourself. So this is from the Presidential Fiscal Policy and Tax Reform Committee. So, for example, give me a figure. If, for example, okay, let's use the figure that we did there, so I can use that to do a test. Look at our taxable income. Then from there, we look at what the tax is. So we are assuming that the person earns 3 million naira per annum. So I'll type 3 million. I hope I've not typed 30 million. 1, 2, 3, 3 million. So, and what was the pension relief that was given to him? 8% of 3 million. So that will be, you can just calculate 8% of 3 million. I think that's 240. Is that 240? 240,000. 240,000. Then, what's the annual rent? 8% of 1.2 million, also 240,000. So, no, this is not what you do. On the rent here, you must put
But
the
the
entire
rent can be up to 500,000.
No, the rent can be, so like I explained that time, the 500,000 is not the rent. The 500,000 is the rent relief. So the rent can, so for a 500,000 rent relief, what do you think should be the rent? The rent amount should be 2.5 million. Because 20% of 2.5 million will give us 500,000. So that means your rent must be 2.5 million. But somebody whose rent is 1.2, so it's 1.2, I'll write here. From the example we are doing, just 1.2, so that the rent relief will now be 240. So the calculator will tell you, put your exact rent amount.
Oh, okay.
Do you understand? Is that clear? Good. So all you need to do, if you don't have other reliefs here, so for example, life insurance policy, if you have it for per annum, you put it, you and your spouse, you put it there per annum. Then if you have interest on loan of owner occupied house, so owner occupied house, it does not have tax rent relief, but it's the interest on the loan that will give you a relief on your tax that you pay. So the more reason why most people are now doing it like a mortgage. So they will go into it as if it's a mortgage. So they pay interest on the mortgage. So it's the interest of the mortgage you can have as a relief on annual basis, not your rent. So for example, if you build your house 20 or 200 million, forget, if it's not on mortgage arrangement, you cannot take any relief. Please, is this clear? I hope it is clear. So calculator, apply the calculator. So this is what you have. So you have a tax of, monthly tax of 21,500 because your monthly salary is 250 for an annual of 3 million that we applied. Look at what we used to be before. If you had used the old tax rate, see the old tax rate beside it, which has 7%, 11%, this is what you will have had, 25,000. But with this one, 21,500, you will now see that why we said it's better for a low income earner, because that means you are earning 250,000 per annum, per month, sorry, to have 3 million per annum. Because some people that are earning like 10 million per month, the Lord is your muzzle. Let's apply 10 million, for example. Okay, 10 million will be 100 million, will be 120 million, right? 1, 2. So 1, 2, and another 0. 120, 120, and 1, 2, 3. Yes. And for example, if your pension, 8% of 120 million is what? Let's quickly look at that. 8% times 120. That's 9.6 million. So you have 9,600,000. Then your rent, if for example your rent is 10 million, because somebody who is earning 120 million will be living in a very good place, or let's say 5 million per annum anyway. So 5,000,000. Now apply the tax. So let's look at what it is. In the new tax law, you are going to pay 2.1 million monthly tax. In the old tax law, what are you going to pay? 1.725. Can you see that? Because you are a big earner, you pay more. Okay, so we can move on, right? So let's move on to, let's move on. So are you seeing the next slide? Am I back to my slide? Please confirm.
Yes.
Okay, thank you very much. Back to my slide. Okay, so the tax ombuds office is just like a licensing office with tax authority. So that's what they just do. They just serve as independent arbiter between taxpayer and tax authority on behalf of the taxpayer. Oversight and compliance and transparency and fairness. So I need to round up because of time. I think we are eating deep. So let me quickly go to impute VAT recovery. So for VAT, it remains the way it is. 7% of VAT is still retained. Impute VAT now recoverable on services, fixed assets, and blah blah like that. So then you also know that there are some vatable item and non-VAT. So zero rated on essentials. What that means is saying that, for example, an example of such products are exports, or agricultural export or whatsoever. So then you are not going to put VAT in your invoice when you are sending it. But that does not say that you cannot claim impute VAT on purchases that you made. So you can see that is a better approach for you. You can still claim impute VAT for the VAT that you paid when they supply you the goods. But when you are invoicing your customer, you don't need to add VAT. So that means that at the end of the year, that input value you are claiming, remember, you are claiming it because it will help you in reducing any exposure to your tax bottom line, which is your CIT and the rest. Okay, so VAT fiscalization and e-invoicing. This one is talking about government. So going forward from 2026, there will be your invoice will be electronic, for companies, e-invoicing, and also VAT will be fiscalized. That is to say that you have to submit your invoices to FIRS. In fact, they need to come and even set up your system so that most of the things that you do, they can also have access to some of your income. So it's not as if people think that they are trying to witch on them. It's not like that. What the government is trying to do is trying to promote enough transparency and accountability, and for companies and for everybody. But now the next question is that this will give us as an opportunity as citizens to challenge them, ask them that, okay, now we know that you have come out to ensure transparency, and we are taking all of these taxes. Please, can we see what we are using our money for? This is the time we can also ask the government for what? For their own stewardship and accountability. Okay, so update VAT sharing formula. I can share my slides so I will look at it. So this is talking about how the VAT revenue is being shared. So 10% goes to the federal government now, then 55% to the local government, and 35% to the state. Now, increased penalty for non-compliance. So what we are saying here is that there's also increased penalty for non-compliance. Before now, so now it is for failure to file, it is now 5 million. Sorry. So there has been some of the updates includes increase in penalty for failure to file returns of to 100,000 in the first month and 50,000, for every other month in failure of companies, failure of companies. So before now, it used to be 25,000, I think, yes, and 20,000 for every other month subsequently. But now it's not 100,000 and 50,000. So introducing new penalties, such as penalty for 5 million for awarding contracts to individual or entities that are not registered for tax, penalties for failure to grant access for development of technology inducing a tax officer. It's also 5 million will be charged. So let me explain this part. I'm sorry, I'm speaking a bit fast because I need to round up. So for even vendors that you are transacting business with, before now, a lot of companies can just transact business with vendors, even who are not tax compliant or who do not pay tax, who do not have tax record or anything, or even file with NRS. So let me not call FRS again, but NRS, Nigerian Revenue Service. So if you are dealing with such contractor, all you need to do is to make sure that they have evidence of tax payment. So how do you do that? Your normal vendor registration process must happen. Get their CAC document, get their tax clearance certificate, let them send it to you. You can even confirm their tax status with with the government. So you must just is a way of telling companies that be careful, because we are out to tell you that even when you are doing business with any vendor, make sure that vendor is compliant or is paying taxes to the government. If we find out that this is happening, you that gave them business, you will pay 5 million penalty for awarding contract to individual or entities that are not registered for tax. That's what the government is saying. So it's no longer them that those people they will look for. It is you they are coming for. So it's just for us to be much more. So the disclosure of tax planning also requires that if you want to do any tax planning, just have a meeting and disclose with the tax authority. And so both of you can sit down and look at how best you can plan even your tax and how to manage it effectively. Okay, so FRS renamed. I've talked about that now. So let's go to top things to do. So what do? Become aware. Be aware. Sensitize board, committee, and executive management. Conduct workshops. Update tax awareness across departments of your company. Become aware. Let nobody come and bamboozle you on things. So you have to be an icon to yourself. Take trainings. Meet people. We're all learning. Even me, I'm still learning. Do you understand? So we have to do that. Then assess. We assess, carry out a holistic impact analysis on your right now. Start carrying out that assess. I have done, for example, now I've been doing back to back. In fact, on Wednesday I didn't come home. I was in the office till like around 1:30 a.m., 2 a.m. I didn't come home. I had to go sleep in an hotel to come back. What are we doing? We are doing impact analysis of the new tax law against this present one that we are doing. So most of our budgets, our payroll and everything, we are now realigning and looking at the impact of what it is now and what it will be next year. So what that means is that there will be more money. You have to pay people more money. If not, some people that are earning more money before now, for example, I showed the example of somebody who is earning 10 million per month, which is 120 million in a year. What that means is that next year his tax will have been high and his net pay will drop. So whatever is earning now, you can't earn that kind of money in January. So what do? You have to think of, do I need to increase the salary? What do we do? So those are some of the impact analysis you need to do. Do you understand? So articulate, reframe tax strategy, set up tax risk register, and other operationalize and implement. Make sure that you operationalize and implement all of these things that we are talking about. Update compliance process, execute your implementation plan, leverage technology, optimize governance too and management framework, then engage stakeholders, to determine a communication strategy and protocol for key internal and external stakeholders. Some examples include shareholders, return ROI impact, like I said, employee pay impact, like I said that time, customer e-invoicing process, vendor KYC, all of this, you have to just begin to do that. Then monitor. So stay updated, monitor the effect, look at the application. It may not be immediately, but just make sure that you are making it in a progressive manner so that you don't have a collapse of the system. Then call to action. Understand tax obligations. Identify specific tax applicable to your own activity, including CIT, VAT, and CGT. Maintain proper books of record. Very important. Proper book of record, very important. Keep detailed financial records to support tax filings and payment. And this regime is saying that for every statement, everything you do, make sure you keep proper books of record and give proper narration to your expenses or to anything you pay. For example, even you as an individual, if you want to send money to somebody, narrate what that thing is. It's a gift to say transfer. Some people just say transfer. No. If it is to buy grocery, say to buy grocery. If it is for gift, say it's for gift. Because when that money is coming to the other person's account, since there is no narration, it could be seen as if it's his income. Although for a taxable person, who is a taxable person? A taxable person is somebody who earns income or also trade or investment, or who does investment. This is a taxable person. So they will now look at it. Are you a taxable person? Before they will now say, okay, maybe that money is from income or from business that you did or whatsoever. But now, to save yourself all of the headache and all of the back and forth, just make sure you keep proper books and you do normal proper narrations in all of your transactions. Tax planning, engage tax planning within the boundaries of the law, then leverage technology, like we say, and stay informed. And I think the sky may be the starting point. Thank you very much for your time and for listening. Thank you.
Thank you so much, Brother Samanene.
Thank you, sir.
God bless you. Yes. So I don't know if you have questions, maybe you can just type it the chat room.
All
Somebody has
right.
raised
Because
their
of
hand.
our time.
So while we are waiting for the questions, but so bro Sam, you said something that small companies will not pay tax at all. What about withholding tax? Has that been cancelled too?
So small companies do not pay tax, even withholding. So what withholding are you going to? You are a small company, so they shouldn't even deduct withholding for you. So you are not the one paying withholding. It's whoever you are doing business with that will deduct withholding before paying you money. But because you are a small company, with your withholding will not be deducted for you.
So what if the two companies doing business are both small companies?
Fine now, it's fine and fine. So they are not. They will just be doing business together.
Okay.
Do you understand what I'm saying? Do you understand?
Yeah, so a company that makes maybe 50 million is doing business with another company that makes 75 million. So they don't have
Just
to
make sure
include
they don't
have to
yeah.
include VAT or the withholding tax or
Yes,
any.
they don't have to charge. They don't have to charge VAT. So people miss withholding tax with VAT. So let me explain. They don't have to charge with. So you that is a customer, you are only charging withholding. You are not going to charge withholding and charge VAT. And so you are charging. You are only sorry. You as a customer, you are charging VAT. You are not going to charge VAT and also charge withholding. So you make mistake and put withholding in the invoice they are sending to a client. It's wrong. So what you are charging, you are only charging VAT. It's value added tax. So withholding is a payment ahead of your company income tax at the end of the year, because you are not going to pay CIT. So why are they going to deduct withholding from you? Do you understand? You are exempt from CIT, you are exempt from VAT, in as long as you are a small company. Did you get that, sir?
Yes, I did. Thank you, sir.
Thank you very much. So withholding is not your business as somebody who is sending a invoice. Withholding is for your client to deduct withholding when paying you money. But because you are a small company, they will not do that, not deduct withholding from you.
Right, Sam, I have a question. Can
Please
I go ahead?
Please go ahead, ma'am.
Okay, so I'm a business person, and my company is, I would say, let's say my company is small. I would say small because every turnover is less than 100 million, right?
Okay.
It's 100 million, right? Yeah. Okay, so I have a customer that gave me a business of about, let's say, 70 million.
Yeah.
And because I am a small company, of course, I'm not going to charge the person withholding tax, right? I'm sorry, VAT. Because because 7.5, normally the charge is 7.5%. When you charge 7.5%, the person will charge you a withholding of 10%. You understand? They charge you withholding back. But normally they buy VAT.
The person will not charge you. The person will deduct. So let's use this.
We deduct the withholding. But the money is still is going to deduct it from your money, no, Nick. So what am I trying to say?
The language you use is deduction. That's what I'm saying.
I know, yeah, I know. Yes, okay. So what am I trying to say? So I did a 70 million business, and I did not charge maybe from a customer A. The customer A came, bought goods for 70 million. Because I thought I am a small company, in quotes, I did not charge VAT. And the customer gave me the 70 million and went away. And I was happy, small company. Now, in 2 months' time, customer Z came and bought a goods of 60 million from me.
Yes.
My turnover now is over 130 million. So what am I doing? Am I going to charge VAT? So if I charge VAT on that 60 million, what happened to the 70 million person that have gone?
Okay, so it's a very intelligent question, and it's very good. So what we're saying here is that by the time you are a business person, you need to plan your revenue. So once that money has exceeded 100 million, you are no longer a small company. No, I said so. So what do you do? You now you charge VAT. So you will watch your revenue. Your revenue is 70 million in the first one that you saw, right? Another
And the
one,
customer
60
had
million is
gone.
coming, and the customer had gone, yes. So no problem. That 60 million, 60,000 million has gone. But even you already know that 70 million has come in, another 60 million is coming in. So at that point, you should have known what to do.
Sam, wait, wait, Sam.
But
Wait,
then,
how
if
will I know
60
what
million
to
has
do?
come in, you have to remit the VAT yourself. You pay the VAT and remit yourself.
Which
Okay, go
money?
ahead.
Sam, which money?
Yeah.
Customer came to buy goods from me, 60 million. Generally, if I have charged the VAT, at least that VAT I will remit. You understand? Okay, now the customer had left my premises and had gone because, as far as I'm concerned, it's a small company, 100 million. Since all this year, and God decided to bless me this year. God wanted to bless me and increase my turnover. So the 50 million there's somebody now working and said that, madam, I want to buy a caustic product too, and I want to do some proof. But the time I calculate their money is 70 million. Okay, 70 million. Am I going to tell the customer, okay, don't worry, don't give me 70 million, give me 40 million, so that the 30 million I will not charge or what?
I have answered you. You will collect your money, but because that has exceeded that band, you pay that VAT. So you have been translated from a small company to a mid company.
So which VAT am I
you,
paying?
You also
which VAT? Is it on the 70 million?
You pay the VAT on the goods.
On the 130 million. I'll pay that. Means I'm going to pay VAT on that 130 million.
On the excess on the excess of 100 million. On the excess of 100 million.
On the excess. Okay, all right. Okay,
but then, let me explain something. You see, sometimes we say we are a small company, but we know that our volume of transaction does not make us small company. So we need to plan. So what that means is that if the person is not bringing, the first month you sold something of 70 million, obviously you know that you have 11 months to go. And you also know the frequency of the sales you make or frequency of your business you do. So from there, you should have known what to plan, how to plan yourself. You are not a small company, even though you are calling yourself small company.
Brason, it's deeper than what you are thinking. I am in business. There's some business, the thing is not, it doesn't come in twinkling. It comes like that. And sometimes when the thing comes in a year on a more serious, because which happens to like a lot of people, if you go and do a pilot study, you see, there are years that, why people call themselves small company. There are some years, like 2-3 years, your turnover, everything might be like less than 80 million. You understand? And you can have a boom. You can have a boom. When a boom comes, comes and be a treasure. See, what kind of plan do you want to plan?
Let me answer you how we manage this as a consultant.
Okay.
Let me tell you how we manage this. You're not going to plan. Well, let me tell you how we manage this as consultants. So, for example, I have a client who is a small company, for example, now under the Finance Act. We say this 25 million was not exceed 25 million. But then, so what we do is that we look at his revenue once it's coming. Once it's close to that, so for example, when it's now above 25 million, we'll tell you you're no longer a small company, Oga. So as it is like this now, let's begin to remit the VAT. So before the end of it, let's begin to remit the VAT. In fact, I said it's not the balance on it. It's the total amount you remit as VAT. Total amount. So let us begin to now remit the total amount back as VAT because we have passed the threshold of a small company. So what will happen is that for the end of the year, you must look at your books. For the end of the year, you have to pay wherever VAT it is. So meanwhile, in the Finance Act, the Finance Act says you'll be filing new return even though you are a small company. But this one says don't even charge and don't even file, don't even pay. But then before the end of the year, look at your book and do what? And make sure you pay if you have exceeded the threshold. For example, I told you you can manage fixed asset also. It's not only the VAT we are looking at, though, even the fixed assets. But once any one of them is above, you're no longer a small company. That's what the law says. Another question. Someone wanted to ask another question. This is 17 minutes past 9. Somebody was trying to ask question again. I thought I saw a hand raised.
Yes, good evening, everybody. Good evening, Brother Sam.
Okay.
Thank you. I'm fine. Thank you. Thank you so far.
Yeah.
Please, as a laywoman in business, a sole proprietor.
Yes.
We are into food business and we don't pay VAT.
Yes.
We work with some organization. Yes, they say we are not to pay VAT.
Yes.
So the main question I want to ask now, in this new tax reform, are we still exempted from paying VAT?
Yes. Yes. I listed the VAT exempt business that time. I listed it for you. But then
I couldn't pick up because of my screen is on.
Okay. But then, mind you, you are not exempted from personal income tax as a director. Hope you are aware.
Okay. That is another question I want to ask.
Okay.
Please, because this thing, I refuse to be confused. And January is normal year, 2025, 26 is almost here. And I need clarification. So what do we do as a sole proprietor?
So
a small business.
So I want to ask you one simple question.
All right.
Now, the first question I'll ask you is that is your company enterprise or a limited? You can be a small company. So enterprise. So that's why that gives me a better definition of what you mean by your sole proprietor enterprise. So
yes,
your income, your own income, and the income of the company as an enterprise will be subject to Personal Income Tax Act.
Personal income tax.
Yes. So like an assessment? Yes, personal income tax. Are you an enterprise to be subjected to Personal Income Tax Act? So that's what I explained. So minimum. So which has that threshold of 800,000 as annual income. Anything above that, you'll be taxed based on the tax table that I showed recently. So what that means is that your income from your company, everything will be a financial statement will be prepared to show that is so. Whatever it is that is your profit will be subjected to the tax table as a personal income tax person.
Meaning that that means we can't file for expenses. That means that the implications we can't file for expenses.
Which kind of expenses, please? Which kind of expenses? No, I thought you have prepared an account. So you have prepared your income, you have prepared your expenses. I said profit will be taxed.
Profit after.
Your expenses will be subjected to tax.
All right.
You understand? Yes.
I am trying to.
Yes. And any other income that you yourself you are earning apart from your business income.
Okay.
Will be subjected to personal income tax because you are an enterprise. You are a sole proprietor.
All right. So it's the same scale we are using. That same scale you give us. Is that same one?
Yeah, that one I showed you, that's the new scale. Yes.
All right. Thank you very much.
From 2025 January.
I'm
2026 January, yeah.
Still trying to take this in, but thank you so far. I'm saying some clarification. Thank you.
No problem. Yeah.
So sorry, people. I know this one is money, so let's take like 10 or 15 minutes more to clarify some things before we finally wrap up. So, Bro Sam, there is a question in the room. How does the new policy affect those in diaspora who operate a Nigerian account?
I've explained it. I explained it that time. You are in diaspora, but so that is the rule under. That's the rule under. So that same rule covers whether physical or not physical, no physical presence. So what that means is, so you are receiving money in in Nigeria. So the money you are receiving in Nigeria, the first question I want to ask is that, where is the income coming from? That's another good question to ask. Where is the income coming from? If the income is coming from Nigeria, it is subject to tax here in Nigeria, even though you are in diaspora. So that's what we call economic presence, economic significance, or economic significant presence. Like I also said, if you are paying tax in UK, whatever tax you have paid in UK, when you come back here, your tax here will be assessed. Any difference, you will pay. But for the fact that you are earning the money in Nigeria, even though you are not in Nigeria, but you are earning it in Nigeria, in Nigerian bank account, and in Naira, you are earning it here, you pay tax here. That's the rule of residency.
Or in a situation where the person does not earn Naira, probably the person earns dollar or pounds, but because sometimes they send money to Nigerians, they convert that money to Naira. So which means that it then goes to their Naira account, and then from there, so is that money, are we going to refer that as money earned in Nigeria or earned in whatever country the person is?
The money is earned in UK, wherever he is, or outside country is earned there. You understand? So, but when it comes to Nigeria, we're also going to check his account. Do you understand? Also going to check all of his account and do an assessment on it. So whichever difference he pays as tax, that's what I've said. So it will not be paid, it will not be double taxed. So for whatever tax he has paid in UK, it will be taken off for him. It will still be subjected to Nigerian tax. But whatsoever tax he has paid in UK, do you understand? Because some people use that to try to evade tax by sending that money, thinking that they will not pay tax at all. So that is also seen as one other rule again. I will call one other rule I will call CFC. So the same rule applies to like CFC. So one of the tests they will do is called control test. So what does CFC say? CFC is saying controlled foreign corporation rules. So what does the rule say? Control foreign corporation rules are tax laws used by countries to prevent taxpayers from hiding income in low tax or tax-free countries. If a company is set up outside the home country but is controlled by residents of the home country, the tax authority may treat part of the company income as if it belongs to the residents, even if the money wasn't repatriated. But here, even the money was repatriated here also, it will also be tested. But then, we are subjected to tax. But then, whatever tax he has paid in UK will be an offset because we have a double taxation treaty with UK. Thank you. Is it clear, Pastor Ayo?
Yes, for me it is clear. Somebody is raising hand. Who is Debbie?
Yeah, Debbie. Okay.
Yes, good evening. Yes, okay. Please, thank you very much for the session. Okay, so I just want to know how to manage. I run a limited liability company. So I also want to know I understand how to manage the salary earners. However, the guys that I pay wages to, I want to know, how do I take care of those guys? And I do a lot of them. The kind of business I do.
The guys that you pay what? I didn't get
wages. Wages to wages.
Wages. Oh, wages. Okay.
Yes, and I pay heavily. Then, alongside the wages guys, is the logistics, those who move things around, which are the Uber guys I call every now and then. And on the transaction, on payment to them, I'll put in logistics to somewhere. How do I capture all of that? And especially since there are money that goes out into, to people that I'm supposed to give to salary. Okay.
I get your question. So those people are not your direct staff. They are not. They are only your logistics and delivery people. So treat it as logistics. So it's a cost to your business. So if I understand it, that your business is a cost to your business. They are different from your back office staff, your staff in your office. Your staff in your office, that one is straightforward. They will be subjected to PAYE, personal income tax.
Okay.
But then for those ones you just mentioned, they are more or less like your logistics expenses. So you treat them as such. And you also have evidence of that.
Okay.
Evidence. And your narration too, you must narrate it as logistics, business trip,
Okay.
logistics. So then after everything, show evidence of that payment you made to them. Yes, they will pay, they will pay income, they will pay tax or whatever later. But that's none of your business. You are paying them because you are doing business. They are not your staff. They are. So and that kind of treatment is taken as your direct cost of business.
Okay, the wages guys too, because that I use them heavily. So in my records, it's going to reflect that major part of my expenses goes into the wages and logistics. That's why I'm just asking that, so that especially the wages.
Especially the wages. So it also depends on the nature of. So those guys, how often do you use them? Did you give them contract letter?
No, it's not that type of. It's like the everyday.
There's no contract letter. There's no employment letter. I'm trying to open up your mind. That's why I'm asking this question. Because when we look at things, we look at it and define it. You look at it from the tax angle and also legal angle. One, are they if you give them employment contract letter, employment letter, or any of so you did not. So they are more or less like laborers or hirelings that you are using. So you take them as well, logistics and wages. But then, if you continue to pay them that way, the law can also tell you that why are you not, since they are contractor, you should have been deducting their withholding. Even as an individual, you deduct their withholding. So withholding tax for individual now is 2%. So for logistics, you can scale through logistics. But once you have narrated wages, you have to now say deduct withholding of 2% on them, because they are not the wages is because they are feed staff or whatever. It's just like as you pay your vendor. When you pay your vendor, you also have to say you want to deduct it. But because even these ones more or less like how do I put it? They're more or less like so there are a lot of complexities around this anyway for now.
It's actually complex because I was going to say that because some of these people are not the people
you know why I said complex? Because they're also individuals. Individuals also are tax exempt. Do you understand?
Yes.
For we told you, they are not exempted from personal income tax until you look at their tax band. So the question now is that these people are paying, are they going to end up to 800,000 naira in a year? So if they are any more than, that's when you can tax them. If they are not earning up to 800,000 naira in a year, they are also tax exempt. So what I will advise at this point, looking at that law looking at those scenarios I just created, what I will advise is that just treat them as logistics. If possible, don't call it wages, call it logistics and let it narrate it logistics.
So bro Sam, I want to chime in on this conversation, right? Remember that part of the law says that you don't deal with people who don't have a taxable entity, right?
Yes.
So, but now you have one Merua that normally brings water to your house. That will deliver water.
I like this part.
You have maybe one bike man that run errands for you, right? You have. So now, how are you now saying that you will not use those guys again because they don't have a registered business?
So it's not possible, my brother. So that it's true. You see, that's why I say every tax that people make, there are always loopholes. So this is one of the loopholes that you just brought out. But the law says that you don't deal with taxable person. So for and I think the penalty when I spelled it out now is 5 million, right? So when the law was looking at this, it wasn't looking at Merua on the street, though. It was looking at proper vendor that you engage as a company. Is that fine? That's what he was looking at. And I will not tell somebody who's bringing water for me now not to bring water for me and I pay. Don't you know that when that person comes, that must I even do a transfer? I can pay cash. Did you get what I'm saying?
But in a situation where you don't have cash, you will still do transfer now.
You do transfer and narrate it as water supply or water or whatever, or payment for water. So
and if your business, let's assume you run a restaurant in a place where there is not enough water and you depend heavily on these guys. So
yes.
are you going to call that a contractor or something?
So then you encourage them to register their business. They must register. So it depends. That's why it depends on how the quantum of what you're doing. Then you have to encourage them to register your business. If not, you also be liable. Somebody who is supplying you water and you are paying him like 50,000 naira for every supply or 100,000 naira, for example, for every supply. It's no longer a small business. It's no longer a small person. Because what that means is that for you to be supplying 50,000, 100,000, it should be registered. Though it may not pay tax. It may not deduct withholding because it's still within the tax band. But at least let him register. So that government will be able to take its own personal income tax at the point where he exceeds the tax band, the tax exempt band. So that's what we are doing. We're sensitizing people. So we're all sensitizing. Even in my office, we're already sensitizing people. There are some people that we deal with that way. We're already sensitizing them.
All right. Thank you so much for tonight. Since we are discussing money now, people don't want to go again. So thank you so much, Bro Sam. This has been really engaging. I don't know if Pastor Sheung is still on the call. Maybe Pastor Sheung, do you mind just giving us a word of encouragement as we close tonight? PS, are you still there? PS, are you still there? All right. So I just want to encourage us. So tomorrow is going to be our grand finale. We're going to be doing our personal financial planning tomorrow. We have Dr. Lola in the house. She is a personal finance coach. She's going to help you to put structure. Remember that Princess said that you need to put a system around what you do. So she's going to teach us tomorrow how to put a system around your personal finance. And Bro Obidi Nwachukwu will be closing the session by showing us practical steps on how, giving us practical steps on how we can make the most of the coming year. I trust that 2026 is going to be so amazing for us all. Before we go, can we please say a big God bless you to our facilitators tonight? Thank you so much, Princess. Thank you so much, Bro Sam. A lot of people have been reaching out to me, Bro Sam, so I will be your PA on this assignment. So I'll be taking the contract for you and then you will be doing the work. Okay, so if you want to reach out to Bro Sam, he's one of our zonal coordinators and he will be willing to give as much as he can give freely. Remember, he said he's a consultant, so we should also pay, especially if you run a business. So pay for information so that you don't run into deformation. All right. So once again, thank you, everyone. It's been an amazing night as we sleep and meditate and plan and pray. I pray that the Lord will give us insight. It will give us understanding, and whatever it is we need to do and to plan for the coming year, God will open our eyes to see them in Jesus' name. And next year, 2026, will be a year of manifestation indeed for every one of us in all aspects of our lives in Jesus' name. So enjoy the rest of your day. If you're in Africa, have a very good night and see you tomorrow, 7 p.m. West African time. God bless you and have a refreshing evening. Bye-bye.
Bye.
Have a great night, everybody.
Bye.
Bye.